Welcome to our review of investment case studies and the practical lessons they offer. Over the next slides, we'll explore real-world successes, key themes driving returns, and actionable takeaways to help you make clearer portfolio decisions as markets evolve, combining high-level context with grounded advice to guide your investment thinking. Tesla's story shows how a focused technology and execution advantage can transform a niche automaker into an industry leader, driven by breakthroughs in battery tech and autonomy while facing intense competition and regulatory scrutiny. So we should celebrate the growth but remain mindful of valuation and market cycles. NVIDIA's rise highlights how AI demand can fuel extraordinary revenue growth, supported by deep partnerships across cloud and technology firms. Yet it also reminds us that hype cycles create volatility, so disciplined position sizing and a long-term view are essential when riding fast-moving tech themes. Gold's resurgence in 2025 is striking, a near 30% rally driven by inflation worries and uncertainty, and roughly 26% renewed safe haven demand despite rising rates. The takeaway is gold's dual role as an inflation hedge and diversification tool, especially during geopolitical stress and market turbulence. Emerging markets present a contrasting picture. China's recovery is powered by AI and green energy policy support. India benefits from demographics and digital expansion, and both offer upside, but investors must watch geopolitical tensions and policy unpredictability when allocating exposure. Now we shift to practical investing strategies you can apply today, focusing on resilience, disciplined thematic exposure, and tactical allocation choices that reflect both opportunity and risk management as you build a durable portfolio. Building resilience means staying invested to capture long-term growth while diversifying across assets, balancing exposure to innovative sectors with defensive holdings, and monitoring macro indicators and central bank signals so you can adjust positioning without overreacting to short-term noise. Tactical asset allocation is about adjusting equity exposure to cycle positioning, selectively managing bond duration as rate expectations change, and integrating alternatives to reduce correlation and improve diversification, all while keeping clear rules for when to tilt or trim exposures. Thematic investing works when disciplined. Concentrate on secular themes like AI, clean energy, and healthcare, implement through diversified ETFs or active funds to avoid concentration risk, and preserve risk controls through position sizing and regular rebalancing to manage hype-driven swings. Sustainable and impact investing should align goals with financial returns by rigorously evaluating ESG credentials, using third-party ratings and corporate disclosures, and focusing on long-term value creation where sustainability supports resilience and growth alongside measurable outcomes. Dollar cost averaging and a long-term perspective help mitigate timing risk by investing steadily through cycles, maintaining emotional discipline to avoid reacting to short-term volatility, and emphasizing compounding and dividend reinvestment as central drivers of long-term wealth accumulation. As we move into risks and challenges ahead, picture the storm image on the slide. Markets will face shocks and uncertainty, so our aim is to recognize key threats, plan for multiple scenarios, and keep portfolios flexible enough to respond without panicking. Inflation and interest rate uncertainty complicate policy decisions and market expectations, creating two-way risks for rates and asset prices, so hedging through diversified exposures and maintaining flexible strategies is critical to navigate shifting macro data and Fed guidance. Geopolitical and regulatory risks are persistent. Trade tensions and policy shifts can disrupt supply chains and corporate profits, regulatory changes can reshape industry economics, and geographic diversification becomes essential to mitigate concentrated exposure risks. Market volatility and sentiment swings are amplified by technological hype cycles, fragile investor sentiment amid mixed data, and the need for strict risk management. Disciplined stop losses, position sizing, and diversification become paramount when headlines drive rapid price moves. Environmental and social risks are increasingly material to valuations, with climate impacts affecting infrastructure and long-term assets, evolving regulations changing sector dynamics, and growing governance scrutiny influencing corporate performance and investor decisions. Looking ahead to trends to watch, we'll explore how technology, digital assets, climate finance, and demographic shifts are reshaping capital allocation, creating new opportunities but also requiring thoughtful implementation and robust risk controls. AI and automation are transforming asset management through smarter portfolio construction and real-time risk analysis, expanding access via robo-advisors and personalized solutions, while raising important ethical questions around transparency, bias, and responsible deployment. Digital assets and blockchain show rising institutional adoption and tokenization potential, yet regulatory frameworks are evolving unevenly and persistent risks like volatility, custody, and security remain central considerations when thinking about allocation. Climate tech and green finance are shifting capital towards renewables, carbon capture, sustainable infrastructure, and ESG-linked financing, with the net zero transition fundamentally reshaping which sectors attract investment and creating clear winners and losers over the coming decade. Demographic shifts and wealth transfer are creating new investor profiles with different priorities. Rising financial literacy and tailored advice matter more, and impact-focused investing grows as heirs and younger investors prioritize values alongside returns. Now we'll turn to building your investment plan and practical steps, combining clear goals, diversified strategies, and disciplined execution to progress from concept to a living portfolio you monitor and adjust over time. Defining goals and risk tolerance starts with clarifying objectives, whether growth, income, or preservation, assessing your time horizon and capacity for risk, and aligning your portfolio mix to match those priorities in a way that's realistic and maintainable. Embracing diversification and flexibility means using a multi-asset approach to manage risk, staying nimble to adapt to changing conditions, and conducting regular reviews and rebalancing to maintain target allocations and capture gains without drifting into unintended concentrations. Leverage professional advice and technology by engaging qualified advisors for customized strategies, using sophisticated digital tools for portfolio monitoring and analysis, and committing to continuous learning so you stay informed about trends and best practices. Staying disciplined and patient requires resisting the urge to chase short-term trends, focusing on long-term compounding and consistent value creation, and exercising emotional control during volatility to avoid panic selling or over-concentrated bets. Investing with confidence is about applying the frameworks we've discussed: clear goals, diversified and disciplined execution, thoughtful thematic exposure, and a readiness to adapt, which together build the conviction to navigate uncertainty and capture long-term opportunities. The investment opportunity in 2025 centers on compelling growth driven by AI and technology, a strategic approach emphasizing diversification and active management, and aligning thematic investments with sustainable progress to pursue both returns and positive impact. For your next steps, stay informed about market developments, prepare and adapt strategies with flexibility and discipline, and move forward with confidence through informed decisions. Your journey to a resilient, forward-looking portfolio begins with consistent action and thoughtful review.